All right, so go ahead and start with the disclaimer. So tonight's Saturday session is for educational purposes only and merely just ideas given by me. Nothing stated during the Zoom session should be taken as an indication to buy or sell. Nothing stated in the Zoom session should be seen as an investment advice. If investment advice is needed, I ask that you please contact a registered financial advisor or fiduciary. Like I like to say, financial advice, financial advisor. All right, so I'm gonna go ahead and share my Thinkorswim. Let me know if y'all can see that. Okay, perfect. All right, so understanding charts. I'm going to break it down on how I actually set up my charts. I'm going to go through sort of fast, not too fast, but just going to go through because I do have the course that I put out where I put out how to put your moving averages, how to put your Bollinger Bands, and all that other good stuff. So if you need me to slow it down, please just unmute yourself and ask me to slow it down or leave a comment and I'll get to it. So first, what I do is, and it's just my paper account, just so y'all know. So I go to studies, I go to edit studies, and I add in my moving averages. So I do two moving averages, a 20 and a 200 day. Then I add in my Bollinger Bands. My RSI, which is already on there, and then my MACD. Make this 200, change the color. And then adjust my Bollinger Bands. So I do 2.5 so I can have a little bit more room to play when stocks are going up and stocks are going down. I feel like when it hits 2, me personally, I think that's too close. So I like a little bit more room to play with. And then I'm gonna change all these colors to the same. Apply. So that's how my charts look when I start off. So from here, I add in my support and resistance lines, go to drawing. In the drawing tools, I use the price line, or price level right here. In the way I chart mine, I go to the low, chart the low first. So 191. Now chart my high. Right now, I'm on the 20-day, 1 hour chart. I do all my charting on 20-day, 1 hour. From here, I do expand it to the 180 and the 1 year just to see if I'm going to put more lines on there. But this is how I set up mine. So from this point, I'm going to go through and I'm going to chart drastic changes. So if it shoots up like this and it stops, I'll plot that. I'll plot this because this is the low right here. It shot down and it stopped and it started pushing back up. And then from here, I'll take a section and I'll look at it and see what it did. So stops right here, shoots down. I'll plot that one. This is still going down. So I'm gonna plot here just because it didn't go up. And then also if you look at over here, this is how you can tell if you're starting to plot right. You'll see it line up with other things on the actual chart. So a lot of people talk about false breakthroughs. I'm not gonna plot this because it falls and then it shoots right back up on two candles that are exact same size. So it broke through it, but it wasn't significant and it never continued its downtrend. So I look at that like it's not real, so I don't plot it. And if you wanted to, you can just keep it just to show right here and not actually extend it all the way through. Take another section. Plot right here. Strong green candle. And then another reason I like that one is because you see throughout the days, it went sideways. Last section. And then just because this went sideways, I'm going to plot this just as a little window for me to tell that it's just playing around in here. So the way I'll look at this is saying, okay, so CRM, Salesforce, played around going sideways for 3 days straight. And then it tried to push up a little bit, but it fell right back down. So this little section would be a window that I'll look at and I'll keep an eye on to see if it pushes further down or if it's going to shoot up. So from here, look at the 180. And I'm good with this chart. So the way people read charts and understand charts is different for some. Some of them do it differently, but the way I do it is I look and I see where it hits a support or it hits a resistance line, and I'll go from there. So right over here on the days that we just passed, it broke through the bottom of the Bollinger Band and it hit a support line and it bounced off and it started going back up. Over here, it broke through a little bit, started playing with it, came all the way down, and that's where you see that. Hit the top, close to the top of the Bollinger Band, push back down. So the way I would look at this is I wouldn't mess with it. So a lot of people try to read these for puts. I don't mess with puts as much because I feel like if the stock market is supposed to go up, unless it's a big drop, like I know, so over here, I would have looked for a sell-off, but obviously it didn't. It went sideways. So since it didn't sell off within these 2 days, I'd have stayed away from it. Or if you want, you can look at it over here and say that it's going to sell off eventually and put out a long put because it is close to, it's touching the Bollinger Band. It still can go up, but if it breaks right here, that's still out of the Bollinger Band. And then if you don't know how to read Bollinger Bands, this is just showing you the volatility and the volume that's happening right now, which is why it's so wide. And then when there's less volume and less volatility, it comes in closer. So if you look down at your RSI, you'll see that it was overbought. Once it hit 70, overbought meaning it's going to probably fall eventually because too many people bought into it. And then if you look over here, it's oversold. And this is how I played Tesla this week when I got in on lows and wrote it up some. It was oversold. In stocks like this, they want to go up, so they're going to try and shoot. So as you see, it was oversold, and then it tried to shoot up at the end of the day. But then it started selling off again. Oversold, and then try to shoot up. So that's how I read certain charts. I'll show you another one. We'll look at Tesla. So the purple line is the 200-day moving average. Extend to the left. So for that one, so your 200-day is the average of the 200 days prior. So let's look at a year for this one real quick. So this is why people was talking about how Tesla still has room to fall. If you look at the year chart, you see in the year, it's way above the 200-day. It's still sort of in the middle of the Bollinger Bands. So technically, Tesla still has room to fall. But what I was saying in the chat, if you look at Tesla, yes, I know they did the 5-to-1 split, but everything is still adjusted, right? So if you look at the chat, if you look at this chart right now, you'll see Tesla runs at the top of the Bollinger Band anyway. It fell down here, but it went right back up, and it runs towards the top. So when people say Tesla can still fall, yes, theoretically, it can still fall, but this is the way Tesla runs. It runs towards the top of the Bollinger Bands. It'll correct itself some, but it's going to stay towards the top of it. So let's go back to the 20-day and finish charting this one. So that's the high, that's the low. Let's take a section. Extend. Take a section. extend. Extend. So if you look right here, I put this line right here. And then if you look over here, how it played around going a little bit through, you can move this down a little bit, activate it, and put it right there. And I wouldn't worry about this because it's real small of a candle. So nothing really happened with that one. And it pushed right back up. But this is where it's coming to. It's coming to this line. So Tesla is playing around with 384. And this is how I figured out my strategy for the calls that I did this week. The 2 calls I put in for Tesla when it was dropping. Coming down here, hits this. It's coming to the end of or close to the bottom of the Bollinger Band. And you know Tesla wants to go up. So if Tesla wants to go up, it's gonna, if it goes too far down, yes, 392.40, yeah. So if Tesla goes down, it's gonna try and push back up. People aren't really selling off on Tesla. Right now, people are trying to get profit, and that's it. So if people are trying to get profit, pushing the price down, people are gonna see that the price is down, and they're gonna get back in it. So if you know that for certain stocks, if you know that for Tesla, if you know that for Apple, they'll fall for a minute and then they're going to turn right back around and they're going to go up. So when you have good stocks and you know, so when you have, so if you have good stocks or whatever that you know people want to get into, so your DocuSigns, your Teledocs, your Teslas, your Apples, your Amazons, when they fall, you know they're going to turn back around. So if you catch them when they hit some type of a line, you can watch it and see if it's going to shoot right back or if it's going to try and push through. And then you can get in on that candle and then try and push it up. So you bought a call option when it hit 390 price. I actually brought my call option when it hit 388 and it pushed up to 420, I believe.
So Ty, what was your option?
It was so when I do intraday trading or swing trades, I always still have them sort of long, just in case there's another big sell-off. But my option for Tesla was still March 19th, 2021 for 550 strike price. I know a lot of people like to play it, a lot closer and do maybe a month out or a couple weeks or 2 months. Those are cool. Those are cheap, but they don't give you any wiggle room. So if Tesla would have said, nah, or somebody would have said, nah, I'm selling all my shares today. They just woke up on the wrong side of the bed and they sold all their shares. And you get a 2-week, 3-week, 2-month option and it just drops $10, $20, $50. Now you got to try and hope people get back in and push it back up. So I don't like playing real close. No, 550 strike price was $550. So Tesla is trading at 390 something right now. When I got it, it was at 388, and it was saying that Tesla would go to $550 by March of 2021. But I knew, see, this is where our goals come into place, right? This is where our rules come into place. When I bought that contract, I knew I was selling it that day. So regardless of where it went, the contract I bought, it was 550 strike, and it was $60 per share. So $6,000 for that contract. But yeah, so I got you. And I sold it probably within a couple hours, and it pushed up, and it was worth $74 a share. So 7,400, about 1,400 profit in a day. But I mean, you definitely could. So there's different ways of doing it, right? You can do that, or you could have did a 1 month out, right? And did 1 month and then did the same exact strike price, but it'd have been way cheaper. You could have gotten way more contracts and possibly made more money. But on the flip side of that, like I said, the reason why I don't like doing that, I bought it at 388. What happens if it would have dropped to 370, or it would have dropped to 350? Because if we look at it, like I said, Tesla still has room to drop. Will it drop below this line? I personally don't think so. But I mean, it's still over, it's at what, 57 for a year for the RSI. I mean, it's in the middle of Bollinger Band. Like, it can theoretically come all the way down to right here. And then it can come all the way down. I mean, this would be the 200-day moving average. So it's possible. But if that happens, that's crazy news. That something was said in the news. Elon Musk did something for it to drop that far. People aren't getting rid of Tesla like that. There's no reason to. Unless somebody does something in that company, unless they figure out that, I don't know, their Tesla plants or shops or whatever have mold in them and nobody can work for a year. Something bad's got to come out for it to continue to fall. So this is one that you could have put a put on. When I was saying that the only way I would put a put on something is if it drops drastically. It hit, and you see, as soon as it hit 538, it just crashed right here. So if you was watching in the pre-market, you would have saw pre-market, it stayed right here for a couple hours, and then right around 6 o'clock Central, so 7 o'clock Eastern, it just tanked, what, $30. And then the next hour, it tanked like $20 more. And the market opened, it kept on going. So you could have you could look at it, but always just verify, because as soon as it did that, it pushed right back up. So you would have watched this candle and you would have saw how the market opened. This is where the market opened. It would have still been falling right here. This is a 1 hour candle. So this is another thing that I want you to look at. When you're trying to do quick trades, never look at just the 1 hour. Yes. So let me highlight this. This is an intraday, black. To the right of it is post market. And then this is intraday over here. To the left of this is pre-market. So the middle is where it cuts off. So if you see this dotted line right here, so where it cuts off, the end of the actual trading day. And then this is the start of the pre-market for the next day. And it goes in. So where was, all right, so if you look right here, when it was at 538. So this is everything you would have seen if you would have looked at it from a 5-minute candle instead of looking at that 1 hour. So if you're going to try and make strategic trades like this, watching it actually fall, you need to change your view to a 5-day, 5-minute, or you can do a 5-day, 15-minute. But looking at the 1 hour, actually trying to get in and out of trades is doing yourself some injustice, because you're not going to be able to actually pinpoint what it's doing throughout that whole time. So when sideways pre-market and you see it starting to drop, and this is all 5 minutes. Every 5 minutes, you see it's dropping, it's dropping, it's dropping. Right before the market opens, you see it push up. So me thinking, I'm like, all right, people are trying to get back into it. I'm gonna watch it. The first 5 minutes, it drops. Don't do anything with that first 5. You watching, you see the next 5 minutes, it pushes right back up. And then from right here, you see it drop 2 candles. So just being honest, if I saw this, I'd have got in. If I was doing a put, I don't do puts on Tesla. That's just one of my rules. But if I was doing a put, I'd have got in on this candle right here, because I saw 1 and 5, and then this was confirming that it was dropping. Got in. You could have wrote it down. And then right here, you would have saw it pushing back up, and I'd have got it out somewhere over here. So you would have rolled that one down. What's that? Almost $20. And I'd have got out watching it go from here. Then it pushed all the way up. Then you see another red candle, try to come up a little bit more, and you start seeing it go down some more. You could have got in back in on the trade over here, and you could have rolled that down. So you just got to realize, with a lot of trading, intraday traders, what they do is, in day traders, they get in and out of stocks all the time. If you have something like this and it's actually a long trade, so a 3-4 month put, you could have just stayed in right here and you could have seen what it was going to do. You would have been pissed off from it going up. You'd have been like, dang, I should have got out. But if you would have stayed in, you could have wrote it back down. it would have ended, and then the very next day, it would have pushed even further. So you would have got lucky on that one. But you just got to know when to be happy with your profit. Then it kept on going. And then it started trying to push back up. Started trying to push back up. Then it fell a little bit more.
So Todd, with Tesla not making it to the S&P, is that gonna make it go down on 60?
Yes. So it was bad news. If you see, this is what happened when that news came out that it wasn't going to go on the S&P. You see, it stopped the end of, what was that, Friday? It stopped up here at 425. Sometime after the market closed, the news that it wasn't going into the S&P came out, and this is what it did. So that, I wouldn't say it's bad news, but it is bad news because Tesla was waiting for it. Tesla pretty much fulfilled all their requirements for getting into the S&P. And then to find out that they're not going to go in, it's kind of like a slap on the face. So people, they want it there. They're like, oh, dang, what the heck's happening? So people might sell off a little bit. I'm sure some people were expecting it to go in. So they were trying to stay in and get some money, because I'm sure when it got in the S&P, it was going to probably go up 5-10%. But since it didn't get in there, it started falling down a little bit. I still don't think it's going to go too far.
You mean too far down?
Yes, I don't think it's going to go too far down. But that's just me. Let's look at it from a 20-day. If it did drop, because of the S&P news, I could see it hitting 370. But going anywhere under 370, I just don't see it happening. Look at this. Yeah, yeah, I don't see it happening. I mean, there's, 2 more weeks before Battery Day? People are still trying to align themselves. Correct. So a load the boat, I mean, that's if people just continue to sell, though. That's all the way down here. That'll put it in extreme. That'll put the year in extreme oversold prices. In the last year, oversold, if you look at it, oversold year is right here. That's March. It's the last time it was oversold for a year chart. If it drops all the way down here, that's going to be oversold. But like I said, anything is possible. But coming all the way down here right now, I don't see it. There's no reason for it to. Just because it didn't get into the S&P still doesn't take away anything from Tesla. it's just a slap in the face. Tesla's still a good company. Tesla still has battery day coming out. I mean, S&P would have helped them, you know, in their pockets, but it's not any bad news towards the actual company. Any other questions?
So, like, Apple had a 20-day drop. I mean, not a 20-day, a $20 drop. So was that okay? Like, is it gonna go any further? Because it went down to like 110.
So let's look at it. Oversold on this day. To 180. It hit that Bollinger Band. Let's look at the year. Still in the middle. And I'll get to your 200-day moving average. I saw it. Maybe push back down to 110. I said in the chat that I can see it going to anywhere between 90 and 100. But after this past week, it trying to push back up. Because I know it tried to push back up, I think Friday, and everything happened.
Hey, was that due to those South Bank calls?
Say that one more time. I didn't hear you.
Was it due to the South Bank calls? Like they bought all those options?
So a lot of stuff was, I'm sure, pumped up because of that. And then when they sold or pulled their money, it's gonna drop the price. I mean, that was a lot of money that was put in to a lot of different companies, tech companies at that. So with us not knowing that people were just spending that much money in the market on certain stocks, and then everybody's just feeding into it and pushing it up even more. So that's one thing that we just got to be wary about from here on out is when you see a stock just climbing rapidly the way it was. Because if you remember when, let's go back a little bit. It's earnings call right here. When it hit its earnings call, like for the next 3 days, it just shot. And then it went sideways, and then it just shot again. So all this was, yes, it was the split hype, but all this could have been South Bank putting in money, people seeing it run, people hopping in, putting in more money. Because you see the volume was high right here. Volume is high. It's no volume. Then volume is high again. So all this volume most likely is hedge funds, big name investors putting in a lot of money. And then investors like us seeing everything and trying to get in also. And then when they finally pull, you get stuff like this. So But I'll say this as well. With Apple, history showed that Apple actually ran up for 2 days, and this is actually right on point. After Apple splits, they ran up for 2 days, and then they dropped for like, I believe it was a week. So they didn't drop for a week. They dropped like the first 2 days, and then they ran sideways for a week. And then after that week, they started pushing up some more. So do I think Apple's going to keep falling? If it falls Monday, I think it'll probably fall back to this range. Do I think it's going to go even further? It's possible, but I don't think so. I think it's going to stay around this range, 120 and 110 for a few more days. And then it'll start its trajectory back up to eventually 200. Correct, Ebony. I know some people have TD Ameritrade or Thinkorswim, and they've been asking me how to get in and out of trades. So I did one because I don't use my paper trade. So I'm just going to show you this real quick, just so you know. I did a Salesforce put just to show. So the 270 put. And if you come over here under monitor, go to activity and positions, you'll see your trades. And then there's a little thing to click on over here in the corner. And this is how you create a closing order. Then this pop up, single sell, everything right here. You can set your limit price to whatever you want to sell it at. Then hit confirm and send. We'll go back to the chart. Any more questions on charts? Or any other stocks you want me to look at?
Beyond me.
I didn't hear you.
Beyond me.
Okay. So I'll do Docu, Beyond Meat, and then the video. Whew. So
Look at this shit.
yeah. So if you
No, this DocuSign.
yeah, this is
not beyond
DocuSign.
this doc.
I'm gonna do DocuSign first because I saw it in the chat.
Oh, okay, cool.
So DocuSign ran up only because of earnings. It's the only reason it ran up. And because it ran up, I mean, you see it like DocuSign's been just chugging along, really. Earnings comes, shoots. And when you see stuff like this, you can't expect, I mean, it can happen because I know Zoom did it where it went up like $120 something, but you're not going to see that all the time. I'd rather you get out over here. It just couldn't go anymore. Obviously, you see that, but yeah, I would have probably tried to get out over here at the end of this day. Let me see. I'm looking at a 5-minute chart for this. Yeah, so I mean, you would have had time because it wasn't like it was just a strong bearish candle. So you could have even held it to right here because it didn't start coming down until the market actually opened. So once you see that, you got to get out right here. This has to be your selling point. You can't, I mean, you can stay in if it's super long out, but when you see stuff like this, boom, 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 and then this, boom, and it's still going, at one point, 1, 2, 3, 4, 5, at one of these 5 red candles, you just got to say, you know what? I have profit. I'm good. Because if you got in DocuSign, you should have gotten in DocuSign over here. Let's see. Let's see the last moment you could have gotten in DocuSign. So if you didn't get in right here, then you should have gotten in right here at 247. At the absolute latest, 263. But that's chasing right here. You're chasing here because your very next candle is red, and that's gonna scare you. Like, oh crap, it's gonna go down. But then you see it pushing back up. Let's go to a 5-minute candle. See if there's another spot. So yeah, you have room. So right here, you see a candle, you see it still pushing. One of these 3, you could have gotten in. You would have saw this, push down. All right, still trying to push up, it's playing around. It dropped a little bit. So you could have ran it to the end of that day, but I would have gotten out at the end of this day. If you just risky and you want to play it, you could have played it overnight. You would have made way more money. But the very next day, you see what happens. Red candle, red candle, red candle. Green, try to push back up. The very next candle, push right back down. Wasn't enough volume. Push back down. So one of these candles, you need to get out. If you didn't get out here, you have room right here. But once you start losing too much profit, you need to say, you know what? I'm good, and just step away. That's why you have your rules. That's why you put those together. Yes, this is when your rules come into play. So I said, if you know exactly what you're trying to walk away with each day, and that's why I have daily goals. So if your daily goals, if you know you're going to be an intraday trader, if you know you're going to be a day trader, you know you're going to be a swing trader, right? And you're not doing just strictly long-term trading or long-term investing, you need to have daily goals. And your daily goals need to be $200 a day, $500 a day, $1,000 a day, 10%, 20%, 30%, whatever it is for that day, you need to go ahead and once you hit it, once you meet that goal, instead of saying, I can make more, you need to be happy with the fact that you met your goal and you get out. There's too many times where I've stayed in a stock where I was like, oh, I met my goal of XYZ, and I stayed, and then it drops on me. And I'm like, dang, I should have got out. And then now you playing, well, now it's back to square one. I'm going to just go ahead and ride it out because I messed up. I should have got out. And now you praying and hoping that it pushes back up to what your goal was so you can get out then. And then look what happens. It continues to fall. So have your goals, stick to your goals. Beyond. Oh, it's 5 day. Hold on. See how long ago this was at a high back in June. And then after that high, it dropped to 124. And then earnings pushed up before earnings, then fell again. Pushed up after. And that wasn't even, so if you look at this, I'm sure there's more stuff in here. But this is post-market. The last 4 hours of post-market, it pushed up. Freaking $12. And then the start of the next day, it started at 130. So all this was just fluff of people getting in right here. And then the gap price of what people actually thought it should have traded at falls back down. And it starts the very next day. But let's go to 20 day and look at it. So what was your question for Beyond? What do you want to know about that? Because if you're looking at it, if you're in the call right now for Beyond, I'm getting out. If you're in it from over here, if you're just getting in right here, I say you're pretty good. You can ride it for a little bit. But if you played any of this back here and it fell, unless it's long, if it's a long call, you're cool. but I don't like how its last high day was back in June. Let me look at the video real quick. And then I believe somebody had a question about the 200-day average also. So 200-day average, let's pull up the video and I talk about it on that. So the way I look at my 200-day average is when I look at the 1 year chart, I see how far down it is to see how hot it's running pretty much. And it's still running high. And then when I look closer, I see that it's right here. So for day trades and swing trades, it's a good look for you, right? Because it should push back up. But when you look at the grand scheme of things and you're like, what can it possibly do? You're saying to yourself that there's a possibility that it can drop some more. And this is where it's the moving average, convergence, and divergence. So the MACD shows you momentum. It's a momentum indicator that shows you whether or not the stock is actually momentuming down or momentuming up. So when this blue line crosses over this gray line going down, it just shows you that the stock is actually going down. When it crosses over, it shows you that the stock is starting to trend back up. So it's just another indicator with all the other indicators that we have to show you which way the stock is actually moving. Correct. Yeah, that's one of the biggest things I think people need to understand, honestly. So I don't know if y'all saw the question, but the question was pretty much, does the stock have to hit your strike price before you can sell it? And the answer is no, it doesn't. If a stock is moving towards the strike price, you're making money.
Can you explain why? I mean, I know why, but I feel like you should go deeper.
All right. So with contracts, right? You are looking at, yes, I'll go over that next. But with contracts, if you're looking at a contract right now and you have a contract with a set premium of, let's say, $10 a share, so that'll be $100 a contract, right? No, it's 10 times. Yeah. Am I doing that math right?
1,000.
1,000. Okay. Thank you. Public math. But so $10 a share, it's $1,000 for that contract, right? You start at, let's use NVIDIA. You start at $500. Let's just say that's the actual stock price. Stock price is $500. Your contract is for $550, and it's $1,000 for that actual contract. That's what that contract costs. As you start to move closer to your actual strike price, that contract becomes more enticing to people. They're like, oh, dang, it's moving in that direction. So it becomes more valuable. As it gets closer to your strike price, it becomes even more valuable. And it's even more enticing to people. So as long as it goes closer, people are like, oh, dang, this is a good one. I want it because it's getting closer to that strike price. He got it at a low premium. And now, as it's getting closer, people are like, I want to get it before it gets too high. So they keep on upping the price for it. So if it gets to a price that you want, long before it gets to the actual strike price, you can sell it to somebody.
Simply supply and demand. The more demand, the higher the price. And then vice versa, right? So if it goes backwards, ain't nobody gonna want that. Want that contract, and so you have less supply. I'm sorry, less demand, and your price will drop.
Correct. And I know somebody was asking me about the stock, and it was going up. And they're like, why am I not making any money on it? A lot of stocks, even if the price goes up, they was making some, but it wasn't making as much as they wanted to. And the reason being is because there wasn't enough demand for that stock. People was like, okay, cool, it's going up. Yeah, that's cool, but I don't really care about this stock. So if people don't really care about your stock, nobody's going to want to bid on it. They're going to say, all right, that's cool, it's going up. Yeah, I'll give you an extra $5 for it. Or I'll give you an extra $10 for it, but that's about it.
Yes, volume doesn't matter. I seen a comment and said, do you pay attention more to volume or open interest on the option change?
So both, honestly. So you want to make sure that there's enough volume in the contract to push it. And then you want to know if there's enough open interest that people are going to actually pay for it. Like if there's no interest in it, then there's no point in getting it. So when we could talk about Mark when he got the Kodak one. Yeah, it dropped, and yeah, he made money, but like he said, he didn't make that much. Why didn't he make a lot of money on it? Because nobody cared about it. Some people wanted it because some people are still trying to play Kodak and hope that Kodak shoots up. But if you don't want a certain stock, why would I pay for it? Why would I pay you to give me this? Like, I don't care about this stock. I don't care about AMC. There's certain things that people don't care about. I don't care about Hertz. I don't care about JCPenney. So you can get contracts for these for days, and if nobody cares about them, you're not going to make any money. When it becomes valuable is when you have a stock like that and it shoots up, right? So yeah, you'll have a Hertz or you'll have a Kodak. Now, if those shot up $20, $30, you probably get some people running to it just because they're like, what's going on with this stock? Why is it shooting like this? Oh, I want it. But when it's starting to come back down, people are like, oh yeah, I don't care about this anymore. So why am I sticking with it?
So question.
What's up?
That same Tesla stock you bought. So if it went the other way, how far out? How long would you have been out, or it would have just went negative, or what? What would happen?
So I have one that's negative right now.
Stay in
I
the trade.
bought. Say it again.
Do you stay in the trade, or you?
Yeah, because and this is why I say have it out far enough, right? I got the same one, March 19th, 2021, 550 strike price. And Ebony, what was the price around the stock price? Do you remember? I don't even remember what the strike price was. I mean, not strike price, what the stock price was when we did that trade. I believe it was like 440. I think.
Yeah, I think it was 440.
Yeah, so I got it when it was 440, right? I'm gonna pull up Tesla real quick. And then I'm going to go to NVAX. So it fell from 538, came down, hit this support line, continued to drop. And I honestly thought it was going to settle right here and not continue to fall. Look, I mean, it's getting close to, you know what I'm saying, the bottom of the Bollinger Band. And this is me even putting it on a 2.5 to give you more room. Imagine if it was on a 2.0. That thing would have been all the way up here, you know? And then I probably would have got in even higher. So that's why I say stick with 2.5. But, yeah, so I got in on that one at 440. And I'm like, all right, I'm cool. It didn't do anything. It stayed. And I thought it was going to shoot right back up. And then what happened? It just kept on falling. And then it started shooting up this day. But to answer your question, did I stay in? Yes, I stayed in. Why did I stay in? Because it's Tesla, and I have it out until March 19th of 2021. Exactly. Time is on our side. Like, this is why you, like, even though I'm day trading stuff, even though I know I'm staying in things for maybe, and I was only going to stay in this call until until October, and I was going to sell it. But the fact that it did this, I might have to stay in a little bit longer. Or with battery day coming up, it might shoot past 538. It might actually hit 550. You never know. So me pushing it out, this is a 6-month contract. If Tesla drops for the next 6 months and does not hit $500, does not hit $550 in 6 months, I'll be surprised. I will be very surprised if it doesn't. I mean, that honestly would be, people just don't care about Tesla anymore. But as you see, Tesla goes from 370 to 425 in one day. I mean, going up to $550 in a week, in 2 weeks, in 3 weeks for Tesla is nothing. So, like I said, if you're going to do trades, if you have the capital behind you to make sure it's pushed out far enough, definitely do that. The only way I would do trades, and I won't do it that far out, is if it's a stock that I've been watching and I seen it push down, push right back up. And I did a couple like that a couple weeks ago. I forgot what it was, but it was literally a 1 week trade. But it was literally because I was watching the stock and it would drop $10, push right back up $12, drop $10, push right back up $12. So one of the days when it dropped $10, I got in for a week trade and it pushed back up. But just certain things that you have to actually watch to do stuff like that. If you're not watching it, you can get burnt.
There are certain stocks, if on most charting platforms, you can look up the average true range, and it tells you how much a stock goes up and down in a day. And there's some,
Okay.
I don't know if
Thank
somebody was asking a question.
Yeah, I didn't know either.
Yeah, there's you can look up the average true range on some stocks. Like some stocks like Amazon, Google, they move like $20, $25 a day. And some smaller stocks like Nvidia, Tesla, they go up, you know, $10, $15 really quick. So you can pick some of those if those are interested in day trading or swing trading.
Exactly. And that's the stuff that you have to make sure you look at. So for everybody that's oh, I want to do these 1 week trades, by no means am I saying yes, do a 1 week trade, 1 month trade. They're just, so I'm risky when it comes to trading, but just constantly doing 1 week, 1 month all the time, that's just too risky for my blood. So that's why I say push it out a little bit further. Give yourself some time. You said what happens when current price shoots well beyond your strike price. I look at those, and most of the time they have low volume. Most likely, if it shoots well beyond, so if it's a stock that is trading sideways for a long time, and then it shoots past your strike price, either your strike price, can you let me know if your strike price was really close? Because if your strike price is if your strike price is like near the money, then okay, I get that. But if your strike price was far out and it's shooting, it's most likely a pump, some type of pump and dump.
Yeah, usually my strike price is closer to the current price. It's not too far off. But I could be overthinking it because what I'm doing is when I look at my options, like if you pick any option today and you look at it and you just go down and say somebody that bought a $36 call on Apple and the current price is 120. If you look at that, the volume is like 0. So once you get to January 15, 2021, and say Apple's at $500, would anybody still want to buy your 120 call? Or you see what I'm saying?
So if your when would your expiration be? Tell me that. Would your expiration be January 2021 as well?
Correct. Yep.
So if your expiration date is January 2021 and you're staying in a contract that's well past the stock price, if your strike price is met and the stock price actually surpassed that, and you're still in it that far out and that close to your expiration date, you're wrong. You should have been out of that. The closer you get to your actual expiration date, the less valuable your contract becomes, regardless of how high you are.
Okay. No, I see exactly what you're saying.
Yeah. So, and it gets to the point where, like this, why would I buy your contract that's, let's use Apple, right? It's $100 today. We have a 105 strike price, and the contract expires on January whatever, and it's all the way to January. Why would I want to buy something that is that close to an expiration date? Like, unless it's significantly higher, like unless it's $200, $210, then I'll buy it from you. But if it's at like 150, I'm like, nah, you just wait it.
I got you.
I'll pull up real quick. And then I'll share my screen to this, and then I'll come back to that. So when you come, and this is what you need to look at. So if you're looking at a contract like that and you're like, okay, I have it. Let's use the same one, January 2021. Current price is 120. Let's do 125. Let's just do one. So if you're at 132, nobody's going to want to buy it. But if you're up here, people will buy it just because it's significantly higher. I'll show you another one. Let's look at, so what was that, 230? So 230 is right here. If you wait to the expiration, it's got to get to 265 for you to get some money. It's got to get to like 290 for you to get the profit that you really want. Because I'm sure you're not going to want to hold it for 6 months and only get $50 or $550. You know, you could have did way more with your time to get $500 and holding the contract for that long. But I mean, there are times where if it dropped, you know, down here, and you was just like, you know what, I'm holding it. I don't want to lose a dime. And then if it did push up, and then you came to $1, or you came to the last day and it was $90, you'd be like, you know what, I'm happy with that. But if you all the way down here and you still holding it, I'm getting rid of it somewhere in here, honestly. If I decide to continue to hold it. But I probably would have sold it back in here if it's that low. But if I'm getting profit over here in September, October, November time frame, I'm selling. If we get too greedy, you start losing. Because we got to remember time decay. Time decay is going to eat at your theta that everybody talks about when they talk about the Greeks.
Yeah.
Your theta is eating at it, you know, each day, but it hits for something that's this far out. It hits after every 5 days. You know, so each day you're technically losing $15, $20, $20, $27, $30 or whatever each day, but it won't affect it until that 5th day. So you're looking at all this, you're like, oh dang, I got $1,000 on this. I want to get more, and it's trading sideways. And then you come over here to 953 and it's still trading sideways, 8, and it shoots up a little bit, take your profit. If we get greedy, when we get greedy is when we start losing. And then that's when you're like, dang, I should have taken my profit a long time ago. And then the longer you stay in trades anyway, the more money you're losing out in the market elsewhere. Unless you're doing a 2-year contract. Now, if you're doing a 2-year contract, then obviously, you know, you're waiting for at least a year, year and a half. But if you're doing 6 months, that's why they say half the time, stay in half the time. Because you have $4,000 or $5,000 tied up, making a couple $100, a couple $1,000. You could have sold that, got that $2,000 profit. Now you have $6,000 you can throw at something. You make a couple $1,000 on that, sell it. Now you have $8,000 you could throw at something instead of just waiting for stuff to get to so high where it's like, oh yeah, I made this $20,000 trade. Make those $20,000 trades on long-term investments, on long-term trades. You'll hit a home run every once in a while with the short term. You know, you get a 6-monther and it just shoots up like Zoom did. You would have put in Zoom when it was going sideways for a little bit, and you might have had it for 6 months. Then it shot up $124. Get out of it. Be happy. Shot up $100. Get out of it. You could have waited until it started dropping a little bit and then get out of it.
So what would be the benefit of exercising?
Of actually taking the shares?
Yeah. If you're losing money, the closer you get to expiration.
So I never take the shares. I don't want the shares. The only time I would do it is if it benefited me to say, I know I'm going to put this in my portfolio. But I will say this. A lot of people say exercising when they're just talking about selling or getting out of it also.
Gotcha.
But the benefit for actually taking the shares is just to have it in your portfolio. That's the way I see it. If you want this stock in your portfolio, you'll go ahead and take them. But if not, I don't see the point. Why put them in your portfolio when you can take that profit?
Right. Got it.
I know somebody asked me about this one. What?
It was me.
What did you want to know on this one?
Because I had got into it about $20, and I'm on the fence about holding it, but there's a lot of days that I want to sell it. So I guess I wanted to see maybe some charting regarding it.
Long term?
Yes.
Okay. So if you got in there at $20, what do you? I mean, I'm sure you're happy with where it's at right now, but you're probably thinking like it was at 189. You're like, dang, I know I can get that much.
Right. So I really don't necessarily want to sell. It was one of those speculative stocks that I got a long time ago, and I really don't want to sell in the 90s. I wanted to kind of march back up until maybe the early hundreds, mid hundreds.
Okay, hold on real quick. No, so exercise is selling your stock, selling that contract. So that word is interchanged a lot between people. Somebody will say, I want to exercise and actually get the shares. Some people say exercise to actually sell the contract. But looking at this, earnings. When's the last time it beat earnings?
It's been forever. Yeah. It's not a very consistent when it comes to earnings.
I mean, so this is one of the ones where I would have to, well, first off, looking at the year chart, I'm like, yo, this thing is just dropping. So this is the start of August. And then it's dropped since August. Looking at the 20-day, it's just been falling. Yeah, this thing will probably continue to fall.
Okay. Thank you.
Yeah, it was what, $13 back in May? A little bit less than that, 17 or $18 back in May. And if there was no real reason for it to shoot, like this would be I need to do more research on figuring out why it went up. If there was some news about it that pushed it up, if it went somewhere, if it went into whatever, I mean, vaccine stock.
Yeah,
So,
and the government gave it about 1.6 billion or some dollars. So that's why it keeps going up, fluctuating.
so I would see honestly where it's at with its phase, what phase it's on right now, how it's doing with that. But yeah, phase 3, trial 3. Yeah. I mean, that's really on you. If you really feel like this is going to be the winner to push out the vaccine, the COVID, cure, COVID vaccine or whatever, you can stay in. But if you're thinking about taking your money and running and putting it elsewhere to make money, I'd at least take out half. So if you got 100 shares of it, I'll take out 50.
I only have a few shares. That's when I was back starting to trade. So it was only like 4 or 5 shares that I copped at $19. So
I'll just take my money.
yeah. Okay. Thanks a lot, Ty. Appreciate it.
You're welcome. And then I think there was an Intel question in here. January 15th, 2021. All right. I'm going to go back to this calculator. So I'm gonna need some more stuff from you. And this is how I figure out my stuff, if I'm gonna stay in or not. So put that in. January 15th, strike, $70. What did you pay? Price per option. Okay. Oh, I need one more thing from you. Your implied volatility. All right. So we're still good right now. Mm, I'd be looking to see if it hit somewhere around here, October, November. Yeah, I figured you were still up. That's why I asked for the implied volatility. So it'll show you, and that's why I like the option profit calculator. It'll definitely show you where you are, even if like you put it in last week or whatever. If you put in exactly what the price you paid for per option, and then you open for the manual entry, and on your contract, it'll show what your implied volatility is for that actual contract. It'll be pretty close on the money where this will actually chart it for you. Now your implied volatility does change, with time, of course, but continue to update that. So as of right now, I can tell you're good on that one. So I would look for it to hit 60 to 57 by October. If I'm going to hold it to November, I want it to hit probably around 63 to 60. But I would be getting out anywhere from October 23rd to November 7th. So if I was going to get out during that time frame, I'm looking 62 to 58 range. That's the profit that I'm going to be cool with getting out at. Obviously, if it shoots up even further, I'm cool with that as well. But that's where I'm going to start looking to get out. Now, if I pull up the chart again, so this is the 180 day. The high for the 180 day was this, and the low to the left is here. And I believe this is when the news came out about their chips and it started dropping. And then AMD started turning around on them. And that's when everybody was like, oh, I'm rocking with AMD and I'm leaving Intel. So another low for a 20-day high into the left. Into the left. Move this. Stand. So for Intel, I mean, it looks good. So what was that price that I said that I was looking for? If it hit, if it went over $52 this month, I'd probably look to sell it if it shoots. So if it shoots up to $52 or 53, 55, I'd keep an eye on it. If it's slowly going up to that, I'd probably start considering to sell. Go back to profit calculator. So if it shoots up to 52, so depending on how slow it goes, if it goes up fast, if it goes up like $1 or $2 a week, I'm cool with that. But if it's flirting with going back down and just playing around in this range of 49, 50, 51, 52, just flirting with that like over and over again, I don't know how long I would hold it. But if it keeps you in the green, I'd stay rocking with it. The moment it came into the white so this is your break even. So your break even, the way they talk about it, your break even at the end of your expiration is what you actually get, what you have to get to for you to break even, right? But all this white area in here is also considered a break even on your contract. So if it stays in the green, I'll rock with it. But the moment it starts flirting with this white area, I'm going to look to start to get out. If it never makes it to the green, like if you don't make it to the green by September, the end of September, then I'll be done with the trade. Like if you stay in here the whole month of September, I wouldn't even rock with it. Like it's not doing things, just playing around. So that's how I would play that one. But as long as you're out here in the green, I'd ride it for a little bit. So different shades of color. Green is your profit. White is your pretty much I'm getting my money back. Break even, quote unquote. And red is I'm losing money, obviously. The darker the green, the more money you make. Lighter the green, it's getting closer to coming back down. So, or if you look at it from this way, white, lighter green, a little bit darker, and then green, it's just showing you the trajectory of how much profit you're actually making. So if you're out here in the green, it's like really good, And if you're ever out here in dark green territory, look to sell. But if you want to, play for more money, you can always just ride it out for a little bit. If you're happy with a 800% profit, then cool. But sell it, if you're happy with that. But if you want to try and make even more, you can sit it out a few days. But when you have stuff like this, you see, when you're up here in your profits, or let's something that's more achievable, right? So you're up here in 388 and you're riding it out. You need to set yourself a mental stop loss. Like, if I get to 300%, I'm selling. If it's not doing anything, if I'm not making money on it, I'm going to sell. I'm not going to continue to sit this one and just hope that it continues to go up. So I'm at 388. Then I'm at 364, 342. I'm like, all right, it's not doing nothing. Shoots three. You know, you just got to get ready to get out. Question: where can I find the implied volatility on option? Okay, did I take too long? Sorry. I'll put my Cash App in here, and if you want to super chat me that way. But yeah, I don't have no problem helping y'all out. Y'all support me, I support y'all. Okay, any other questions? So funny you say that. I was actually just in a XLK and I actually sold it. And the reason I sold it is because I was at $15,000 profit. And then when everything happened, it dropped all the way to $10,000. And I was pissed. So I sold it, and I'm going to get back in September 14th. But if you're doing an XLK 2020, what would your strike price be? Let's see. Let's do the math. Yes, September 14th is when the new contracts come out. And if you supposedly if you get them as soon as they come out, you know, you'll get them for a lot cheaper than waiting. If you're the first person at the party, like Mark likes to say, first person at the party, you can pretty much name your own prices. All right, so stock price 118. So you would look at the price performance, look at the 2-year, $42 change. And then from that, since you're staying a year and a half, well, let's look at it this way. Because technically, it's not going to be a 2-year contract, right? Because we're already halfway in it. I believe that contract is January 2022. Correct me if I'm wrong. So, okay, so yeah, January 2022. So technically, you're only doing that for a year and 4 months. So it's a year and 4 month contract. So if it's a year and 4-month contract, you're only going to stay in 6, 7 months max. I don't have my glasses on again. What you mean? If the price performance is negative, yeah. Price performance is negative, I wouldn't. I mean, why would you want to get into a contract for 2 years and you're looking out and you're like, or 6-month contract and it's got a negative price performance and you're trying to put a call on it, you know? Okay, so I would look at the 52 week. So 52 weeks is pretty much about a year, right? So $38. You're going to take 38 and you're going to divide that by 2 and you get 19. And then from there, you're going to do a 10% correction and you get 17. After you do that, you're going to add that to the actual stock price of 118. So you get 135. So strike price for a January 2022 for XLK would be 135. Now, with that being said, you can choose one up or one down, whatever you want. I personally wouldn't do this contract. It's just too high for my blood for an ETF. I would wait, but I mean, these are the kind of charts you want to see. All this green. And just a little bit of red. You see contracts like this, get in them. So if you have the capital for it, cool. If you're trying to make a couple dollars, fine by me. But me knowing that new contracts are coming out in a few days, in like a week, I'm waiting.
Ty, I have a question.
What's up?
That 38 or that 39, were you looking at the 52 week?
Yes.
Before you okay.
And I looked at 52 week because it's not a 2-year contract anymore. So we all like to look at no, so I did the 52 week because it's not a 2-year contract anymore. If you actually look at it, January 2022, you're only in it for 6 months. If you try to use the 2-year price performance, you're going to have a way higher strike price. So what you can do for that, trying to figure out what a possible, where's it at? Yes, hold on. Let me, I'm going to share this. so I can go somewhere and y'all don't see what I'm typing in.
Sorry, but if you were doing 2 years, then you would just look at the 2 year, right? You wouldn't
Correct.
have to adjustment. Okay. Sorry.
Correct.
Thank you.
Mm-hmm. But the only reason I didn't do the 2 year on that one is because that January contract would expire in less than 2 years. So technically, that was just a 1 year contract.
So that's how you would determine all of your strike prices. You would take the average, divide it in two, and add 10%.
So for anything under 2 years, yes. Take the price performance, divide it by 2, and then take the 10%. If it's a 2 year contract, I'm doing the 2 year price performance and dividing it by a year and a half. Options. Shamika, I'm looking for where to find it for your question. Because I don't know if all platforms have this, but E-Trade does. It'll show you what it was before. Or was it bar chart? I think it might have been bar chart. But I'm gonna look at E-Trade real quick. Where is it? So this is E-Trade. It's the options analyzer. So you can look at whatever. Let's look at January. So the current bid for one is, with that strike, is 15. And then you'll be able to look because I was just looking at this the other day. Where does it show? So it's somewhere on here. I believe it's the analyzer, but I can't figure it out right now. But pretty much what I was going to show you, it tells you what the actual price was of the contract, backdated. So you could actually look at the contracts. And if I'll play around with this some more, and if I find it again, I will do a short video. But it shows you what the actual price of the contract is when it first came out. So you could guesstimate around about what it might be when the new ones come out. It won't be spot on, but it'll be close. Let's see. You can do 5%. It's really how much you want to do. I'll play around with it and see. But I was definitely looking at it the other day. And I was like, oh, this is dope. But these are all the different tools that you can look at in E-Trade. If I'm not mistaken, they're released every around about 3-4 times whenever the cycle ends. So there's 3 different cycles. So at the end of each cycle, it's new contracts put out. I'll show you. So cycle 1 right here, the way you look at it, you have your first month, January, February, and then April, July. Once January finishes, February and March comes up to the front, and then April and July. So the cycle for this is April, July. and then you have July, October, January, April, then April and July again. So for each cycle, the first 2 months are always the same. See, January, February, January, February, January, February. The last 2 months are whatever cycle it's on. April, July, May, August, March, January. These two right here go off of I believe it's the fiscal year. So it's like one cycle, they use the first month. No, it's off of quarters, my bad. So one cycle use the first month of the quarter, the next cycle uses the second month, the final cycle uses like the last month of the quarter. But I believe the new expiration dates come out once you get to the end of your cycle, your initial cycle. So it'll be once it gets to July, new expiration dates that pop out that'll fill the whole options chain. Throughout here, new ones are being adjusted because you have to fill in these other ones, but your long far out, I believe once July hits, once it finishes, so that 4 months, then you're going to get another long drawn out, contract. So these months you'll see it extend for a couple months. You'll see it extend for a couple months. And then you'll get out here and you'll see your 1 year, 2 years extended. Any other questions? Any other stocks? Cool. If that is it, I will stop sharing and stop recording.